Hello, everyone. So, I have brought you chapter number 7. Hopefully, it is going to be one video and not too long, but here we go. So, in this chapter, I'm just trying to get to, yeah. Okay. So, in this chapter, we are going to do almost like a year ahead continuation of chapter 6. Remember, in chapter 6, we had made a whole lot of budgets. Yes, a whole lot of budgets. Now, from the company standpoint, a year has passed and actual numbers are revealed. Now, we are able to compare the actual numbers with the expected results and conduct what we call variance analysis. So, as you can see, variance is simply the process of comparing. Let me catch my pen. This one doesn't want to move. Give me a second. Here we go. Comparing actual results to budgeted results, right? And companies use these analysis to figure out why was profit higher or lower than expected, why did we sell more or less units, why did we charge a different price, etc., etc. So companies are also going to try to use this to do performance evaluation in terms of who should be promoted, who did his job better than expected, who did his job worse than expected, who should be promoted, who should be fired, etc., etc. Okay. So variance can be calculated in multiple levels. I am going to draw a big variance like a V for you. Okay. So we typically start with what we call level 1. Then we are going to go to level 2. And then we will finally end at level 3. As you can see, level 1 is the narrowest part of my V and level 3 is the most expanded part of my V, meaning we are going to keep expanding our analysis as we go along. Okay, so level 1 analysis is called the calculation of static budget variance. So static budget is going to simply compare actual numbers with the original budget, and it is going to give us a number but does not tell us much about why it happened, who is responsible, etc., etc. Okay, from level 1, which is a very simplistic form of analysis, we go to level 2 analysis, in which we are going to make two different calculations. One is called flexible budget variance, which is going to answer for us how well did we perform if we adjust for the volume that we actually sold versus what we plan to sell. Okay. The second one that we would calculate is called sales volume variance, which is going to answer, did we sell more units than expected or fewer units than expected? Okay. Then when we go to level 3, we are going to expand ourselves from output analysis, which is number of units considered, to input analysis, where we are going to start talking about prices of raw material and labor. Again, in level 3, we are going to calculate two variances, typically price variance and efficiency variance. Okay. This is an important thing that I want to put on this slide, which is not only do we calculate the amount of variance, we figure out whether the variance is favorable or unfavorable. So please do not make the mistake of saying that when I subtract a number from another number, if the answer turns out to be positive, then it is favorable, or otherwise, no. Favorable variance simply means that was it a pleasant surprise? Okay, meaning was my actual income going to be higher than what I expected? Then it is favorable. And when I say unfavorable, does it come out to me as a rude shock, meaning my income is lower than what I was expecting, meaning it is an unfavorable outcome for the company? When we calculate the variances, we are also going to try to talk about the favorable and unfavorable sign continuously. Okay. Now let us try to look at an example. I'm making a very simple example up here where I am talking about some budgets that you are given. Company was originally planning on selling 100 cups of lemonade at the price of $5 a cup. They are also telling you that the standard or budgeted amount of raw material that they require is 2-ounce lemons per cup, and they buy lemons at the price of $1 per ounce. So, just some budgeted numbers given to you. Now, we are given some actual numbers which came out at the end of the year, where we are saying company actually sold 120 cups, which is 20 cups more than what they had planned. Okay, their actual selling price is also different than what their budgeted selling price was. They actually used 270 ounce of lemon. We are going to talk about it when the time comes, and the price at which they purchased the lemon are is a little bit higher than what was there in their budget. Okay, now the first calculation that we are doing here is called how to calculate a static budget. Static budget is basically doing nothing but saying actual prices times actual quantity. Okay, so here we took actual quantity, sorry, budgeted quantity and budgeted price, and we came up with a budgeted sales revenue. Then we came up with the budgeted cost of our raw material. 400 cups, the company was saying budgeted raw material is 2 ounce, and each ounce was purchased at $1. So $200 worth of raw material was used in this exercise. Okay, so I wrote actual price and actual quantity. I misspoke. It should be budgeted price and budgeted quantity. Actual price and actual quantity I am going to use when I do the actual numbers. So, sorry about that. Okay, continuing. You can also see that if I were to subtract the material cost from my revenue, I can get a profit of $300 budgeted. So I'm expecting an income or profit of $300 from this exercise. Okay. What happens actually? Suppose I adjust my volume. Okay. This is an important concept. The flexible budget. Flexible budget says, since I was planning to sell 100 cups, and actually what I ended up selling are 120 cups. What if I adjust my budget up, flex it up, so to say, by taking the actual quantity but then keeping all other numbers the same? So what do? I borrow the actual quantity from here, but then I borrow this from here, and I say if everything else was planned and I had a crystal ball and I could see that I was going to sell 120 units, what would my budget then have looked like? Okay, then it would have looked like this quantity and this price. Okay, similarly, I borrow the quantity from here and then I borrow both these things from here. Okay, so this one is budgeted quantity times budgeted prices. Okay, this one is actual quantity multiplied by all the budgeted prices or rates. Okay, needless to say, I can subtract the material cost from the revenue and I can calculate what my flexible budget profit would have been. Finally, the third one is actual results, which is actual quantity sold at the actual rates. Okay, so here I'm saying I have 120 cups which I sold at 450. So my actual revenue is 540. My material cost, I used 270 ounces of lemon at $1.20. Okay, so this is my material cost. I subtract and I get a profit. So essentially, I have three different calculations that I have made here. Okay, one is a static budget column, one is a flexible budget column, and one is an actual column. I am going to try to put all of them in a table for you. Okay, I'm copying some of the basic information up here so that you can see where my table numbers are coming from. I also copied the static budget that you just made and the actual column. I also copied the flexible budget that you had made so that you can make sense of the table I'm about to show you. Okay, so here is the table which is saying, okay, I need a better color pen now. Okay, this is my column 5, even though chronologically it comes in first. Okay, my static budget, as you can see, is based on 100 cups, which I took from here. Okay, at $5 per cup, this is my sales revenue. I'm just copying the numbers in a table. Okay, this is my cost and this is my profit. Okay, notice contribution margin. You have learned this term. Contribution margin is basically sales minus variable cost, and profit is contribution margin minus fixed cost. But since we don't have any fixed cost in our model, our contribution margin is the same thing as our profit for now. Okay, otherwise contribution margin minus my fixed cost would have been my profit, but not for now. Okay, so I just put all the data for the static budget in a table. Okay, let me take you to the other extreme, because flexible budget is going to require a small amount of explaining. So let's do the simple things first. Okay, at the other extreme, I have my actual numbers. Okay, so I want to actually give you the formula. So I'm going to erase this stuff and say static budget, remember, is budgeted price times budgeted quantity, right? This one is actual price times actual quantity. Okay, so what is happening? I took actual quantity, I multiplied by my revenue per cup. Okay, similarly, I got the raw material cost here. Okay, my contribution margin, as I just said, and my profit are both the same numbers because I have no fixed cost. Okay. Now, what happens is that I make the flexible budget column where I borrow the actual quantity from here, but I borrow the budgeted prices from here. Okay. And I make a hybrid column, which is basically saying if everything had gone perfectly, okay, what would I have paid, okay, for making the actual number of units that I ended up making? Okay, so what do? I actually borrow the rates from here. Okay, so I borrowed this rate from here, I borrowed these rates from here, and I came up with a flexible budget. Okay, so this is my flexible budget. Once again, this is my profit, contribution margin equal to profit in all the three columns. Now comes column 2 and column 5. Column 2, as you can see, is simply the difference between column 1 and column 3, which means if I take the difference between actual and flexible budget, I come up with what I call flexible budget variances. Okay, now let us try to understand what is happening here. Notice that my first number is 600 minus 540. Okay, it's 60, but why is it unfavorable? Okay, it is unfavorable. Notice because I was expecting a revenue of $600 in my flexible budget if I had sold 120 units as I actually sold. I was planning on selling them at $5 a unit. So this one is 120 times 5, right? Whereas this one is 120 times 450. So for each glass of lemonade, I got less revenue than expected. Less revenue is never good for the company, and that is why the 60 unfavorable is saying that my profit is less than expected. Okay, now let us concentrate on one number which is favorable so that I can explain why the number is favorable. Actually, they're all revenue and contribution margin. So let's look at contribution margin only. This contribution margin, according to my original budget, was $300. Okay. If I were to flex my units to 120 from 100, okay, then I'm expecting a higher contribution margin. Higher contribution margin, higher revenue, higher income is always favorable for the company. That is the reason why this is also favorable. Okay, so we have calculated. Let me just clean up the slide and tell you that the summary of this slide is that we have tabulated the three columns, this one, this one, and this one, and then we have taken the differences between column 1 and column 2, and we are calling it flexible budget variance, and we are taking the difference between column 3 and column 5, and we are calling it sales volume variance. Okay, if you were to look at the difference between the formulas, let me write down the formula one more time: budgeted quantity and budgeted price. This one is actual quantity and budgeted price. If you are taking a difference between these two, notice that your budgeted price is common out. All you are doing is to actually take the difference between quantity, okay, which is 120, and this quantity, which is only 100. Okay, and your budgeted price in this row, $5, is common. Okay, similarly, if you were to go, I'm going to just change the color of my pen. If you were to go here, this is actual quantity times actual price. If you take the difference between this column and this column, notice now actual quantity is common. All you are doing is to compare the actual prices, which you can see is 450 for this row, okay, and 5 here. 120 is the same. Okay, we will talk about this a little bit more when we go to the level 3 also, but let's just keep this in mind that this is explained in a table, also can be done in the form of a formula. Let's continue. Okay, now let us formally define them as level 1 and level 2 variances. I have just copied the table from before so that you have all the numbers in front of you, and we are going to talk about some formulas. One is that the difference between, let's change the color, the difference between actual column and static column. This difference is called static budget variance, okay, which is 216 coming from here, 300 coming from here, and it is minus 84, which is the same thing as saying it is 84u. Now you can either cram it or you can understand that whenever a variance turns out to be minus, okay, it is unfavorable. Okay, because operating income originally was planned to be $300. My actual operating income has turned out to be lower. Okay, so if my actual operating income is lower, it is unfavorable for the company. If you are talking about a cost, it would be an opposite result, but we'll talk about that. So that is one thing to remember, that the difference between these two numbers is static budget variance. The second thing to realize is that this difference, which is 84u, okay, is split between two: flexible budget variance and sales volume variance. Okay, so static budget variance can also be calculated as sales volume variance plus flexible budget variance. Okay, let's look at the proof. Notice my sales volume variance is 60F, which is this. Okay, my flexible budget variance is 144U, which is this. Okay, which is the same thing as if I were to combine one F and one U, it is almost like combining a negative number with a positive number, and I am going to come up with a negative 84 or a 84u. So all that is happening is that I take my static budget variance and I split it into two columns, and therefore the total turns out to be always the same. Everybody okay? All right. So now we are going to go into level 3, which is the most expanded form of variances. We are going to now sort of break away from this portion of the table. I'll show you how, but we are going to concentrate on flexible budget variances and further split them into two, and we call them price variance and efficiency variance when we go deeper into flexible budget variance. Okay, so I am going to explain the logic one more time, but let us just see the basic calculations first. Okay. Once again, I copied the table so that you have the basic numbers in front of you. I also copied the original information because I need some information on the raw material used. So notice for the standard budget, I was allowed this much quantity of raw material per cup. I was buying my raw material at $1 per ounce. Okay. Actually, what I did was I used 270 ounces of lemon, and I paid $1.20 instead of $1. I also have the flexible budget number where I borrowed the 120 units for which I should have been allowed two ounces of lemon, which is coming from here, okay, and the standard price of that lemon would have been one. Once again, I copied the actual quantity from the left side, but I copied the budgeted rates or budgeted prices from the right side, which is what I had originally done in my flexible budget, which is what you see here. Okay, so I'm actually concentrating on this number and this number right now. These numbers I am kind of not worrying about, because what I'm essentially trying to say is that my flexible budget is showing me a number which says if everything had gone according to plan, okay, how much raw material would have been used for the actual output. Okay, so usually I find in my experience that students understand static budget, flexible budget, they understand actual numbers also, but they kind of get confused when we talk about flexible budget in level 3. So I'm going to kind of elaborate on that a little bit along with the table. Okay, so I made the table sort of a little bit more elaborately so that you can see where the numbers are coming from. I'm going to erase what I have here. Okay, so now notice I'm talking about three quantities. There is an actual quantity of raw material here, actual quantity of lemons. Remember, I'm not talking about glasses of lemonade. Glasses of lemonade was this, which was also actual quantity. And this is also actual quantity, but this is actual quantity of input. This one was actual quantity of output. I'm simply going deeper into my analysis. So I have an actual quantity that I have used, which is 270 lemons. Okay. Then I have a standard quantity here in my flexible budget column. Okay. Remember, I have kind of taken these two out from my life, but I kind of know that in my flexible budget, I was told 120 units. Okay. Each one of them allowed two lemons. So 240 lemons at $1. Okay. Is the number that I have here. Okay. So this is the second quantity that we have, which is the standard quantity allowed, right? Remember, just to kind of clear the confusion, there is a third quantity which we are never using, which is my original budget quantity. How much was that? That one was 100 units at 2 ounces of lemon. Okay, 200 ounces of lemon, which I never use. Why? This budget of 100 lemons, 100 units of lemonade never panned out. Okay, so this quantity is what students typically confused. Okay, I want you to compare this quantity with this quantity. This is the right quantity for our 120 units that we actually produced. This is a wrong quantity because this is based on 100 units. Okay, now once you understand that, then I'm going to kind of clean this one up one more time and talk about what we have calculated. What we have calculated here is to take actual quantity of input multiplied by actual price of input, which is cost of lemon, not cost of lemonade. Okay, and I come up with $324 actually spent on material. What we have done, we have basically split 324 into this and this two numbers. You with me? Okay, now we come to the flexible budget where we have taken this number, which we have gotten by taking this calculation. Okay, this number is here. Now we are actually taking 270 lemons from here, and we are taking dollar per unit from here, and we are creating a third column in the middle. Okay, this column is called actual quantity multiplied by standard or budgeted prices, both of them belonging to inputs, as in lemons, not lemonade. Okay, why is this column there? We simply call it a middle column because we want to hold the quantity constant on the on the left side and compare prices. Okay. So now if you look at this price variance, what is this doing? Actual quantity of input is common in both the columns. Actual price of input inside the bracket and budgeted price of input here. Okay. So we are simply comparing the prices inside the bracket. Now if you look at this calculation, which is the efficiency variance, which is 2 minus 3, what is happening here? This column is budgeted quantity allowed. I'm going to put a star here because I want to say budgeted quantity allowed. Okay, multiplied by budgeted price. This standard quantity, okay, is not the same as the standard quantity here. So I want to kind of put a star here. Okay, so now I have actual quantity of input minus budgeted quantity of input allowed. Remember, standard and budgeted are used interchangeably. Okay, and then I can take budgeted price of input common out because it is common in both of them. Okay, so notice $1 is common. I can take that out. And what am I comparing? 270 with 240. So 270 here and 240 here is going to give me 30 ounces of lemon. I have used more, and because lemon costs $1 per ounce, my company has worked less efficiently, and therefore I have spent $30 more, which is an unfavorable variance because the company does not want to spend overspend on raw material. Okay, so basically the most crucial thing to understand on this slide is the calculation that you are doing here, which is standard quantity allowed. Okay, so we took the budget from here, we took the actual number from here. So this is the only hybrid number that we are using, and therefore the calculation of flexible budget number, okay, in the last column, which we are calling column 3, okay, is the most important thing. So we have to kind of do this in order to isolate our causes. And also notice this is my actual column and this is my flexible column. So this is my flexible budget variance from level 2. Okay, I have now split that into two. So needless to say, flexible budget variance is always equal to price variance plus efficiency variance. You can also check my flexible budget variance was 144U here. If I were to compare the flexible budget variance from there into 54U, what's going on? Did I say something wrong? It should be equal to 54U plus 34, which is coming out to 74U. So, oh, this is an operating income. I'm sorry. This is what I wanted to talk about. Okay. The direct material flexible budget variance. I apologize, not the operating income variance. So, 84U is a combination of 54U plus 30U. Okay. So, we will stop here and we will talk more in more detail in class. Have a nice day. Thank you. Okay, sorry, I forgot about this slide. I simply put together all the formulas which you can see. So now I should say final thank you.